We have our second talk of the afternoon session today. So let me introduce the next speaker. We have Jonathan Chiu, who is a Director of Banking and Payments Research at Bank of Canada, presenting his research. His main research interests are about monetary theory, banking, payments, and financial infrastructures. And he's also the organizer of Central Bank and Digital Currency Virtual Seminar Series. He was hosting an event earlier today, I know. And he's gonna present his paper on the inherent fragility of DeFi lending. So you have 15 minutes plus 10 more minutes with the questions.
Thank you, Catherine. Let me first share the slides. Okay. Can you see the screen?
Yes, all is good.
Thank you. Well, also, thank you very much for the opportunity for me to present this paper today. And this is still ongoing work, first time that we present this paper. I'm from the Bank of Canada, so the usual disclaimer applies. This is a joint work with my co-authors, Emery, Kathy, and Shenzhen. Yeah, I believe some of them are in the audience. And this paper in the topic is kind of related to what Alfred presented earlier, is on DeFi lending, but we are looking from a different perspective, as you will see. As we know, right, DeFi aims to offer financial services by using autonomous smart contracts to replace traditional intermediaries. And since 2020 summer, right, the so-called DeFi summer, there has been a tremendous growth, right, in terms of both scale and also the scope, right? This graph basically shows, right, how the total value of tokens locked into DeFi contracts has increased over time, and within 2 years now it has reached $230 billion. In terms of scope, there are many different DeFi services, right, provided today, and today we'll focus on one segment, the DeFi lending segment, which accounts for about 20%, 1/5 of the total value lock. And as Alfred has mentioned, right, so DeFi lending is a major component of DeFi now, and there are some popular platforms such as Aave and Compound, both running on Ethereum, and also Venus, which runs on BSC. And then one feature of DeFi lending is about its volatility, where, for example, here we put one statistic, which is the volatility of this total value of Aave loans, right, over 2021. As we can see, this volatility is much more volatile than standard loans, right? It's 10 times more volatile in terms of the weekly measure of coefficient of variation compared to standard U.S. bank loans. And recently, right, policymakers have raised concerns about the financial stability implications of these DeFi arrangements. But despite this, formal economic analysis on this issue is relatively limited, right? So you get seen Alfred's paper, and this is another one looking from a different perspective. So exactly what we try to do here is to have us think about this question from a theoretical angle. In particular, what is special, right, intrinsically special about DeFi lending relative to traditional centralized arrangement that going through banks and financial intermediaries, right? And to what extent is DeFi lending inherently unstable, right? And how is it related to the crypto asset pricing dynamics, right? How does it contribute, for example, to the volatility of the underlying, the prices of the underlying collateral assets? And as you know, right, so there is this young but fast-growing literature on DeFi protocols. Most of them so far focus on two areas, right? Decentralized exchanges and decentralized stable coins. And until recently, there are very, very little work right, studying DeFi lending. So Alfred's paper and our paper, I believe, are two of the first studies on this topic. But as I mentioned, this is a really young and growing field, right? So if I have missed any citation, please do let me know. And while Alfred's work is kind of empirical study of the liquidation externality, here we're trying to contribute to literature by developing a dynamic model of DeFi lending and crypto pricing. In particular, what we try to do here is to use our dynamic DeFi lending model. We want to study a particular dynamic feedback loop, which is different from the liquidation externality loop that feedback loop that Alfred considered. So our challenge is the following, right? So basically, today's lending activity, both in terms of its quantity and quality, right, depends on the price market value of collateral, because all these loans are collateralized loans, which in turn, right, the value of this collateral in turn would depend on the expected activities of DeFi lending tomorrow. And this dynamic linkage is going to generate a dynamic price liquidity feedback. What are the implications? Well, firstly, it's going to make crypto prices more sensitive to fundamental shocks. Secondly, we show that this linkage can generate multiple equilibria driven by some non-fundamental market sentiments. And interestingly, having frequent and flexible smart contract update, right, indeed could help restore the uniqueness of equilibrium. However, as we will discuss later, this could prove to be difficult, in particular in a decentralized environment. Okay. Before we go to the model, maybe it's worthwhile to think a little bit about how we think that DeFi lending is special, right? Good ways to compare it with, traditional centralized arrangement, because CeFi. This table kind of compares the kind of different aspects of CeFi and DeFi, right? First of all, as we know, right, CeFi is heavily regulated, right? Subject to reserve requirement, liquidity requirement, capital requirement, right? Like disclosure or a deposit insurance, for example. The borrowers, right? Typically, this registered account, right? So they are all identified. And third, standard assets are available, right, for use as collateral in CeFi. And finally, right, human judgment is involved in the writing and the implementation of contracts, right? So all these features, to a certain extent, help to improve loan quality and help enforce loan repayment in CeFi. However, these features, right, are not applicable, right? Some of these features are not applicable in the DeFi environment, in DeFi lending, which is based on public blockchain. Whereas we know there's essentially no regulations, right? And then in the DeFi environment, where agents are anonymous or called pseudonymous. What does it mean? It means that, well, first of all, we cannot do any credit checks, right? Because it's not feasible. And some reputational schemes will also become much less effective, right? Because individuals can walk away from a contract, right, without future consequences, except for losing their collateral. And then on top of that, another thing is that it could be hard to implement certain non-linear contracts, right? Why? Because borrowers can always choose to submit multiple transactions from different addresses, and you can not tell whether or not they belong to the same person. So if the contract is non-linear, it may be subject to this type of arbitrage, right? So because of this, often what we see is that, and then the third feature, right, is that this only tokenized asset can be used as collateral, right? Because you need to lock into a smart contract, the asset has to be tokenized. And this asset typically are very highly volatile, right? So I can show you a simple table that compares the volatility, right, of different, say, stablecoin and other type of crypto asset that are commonly used as a collateral, for example, on the Aave platform, and then compare them also with more standard financial asset that could be used as collateral. And you see that within 1 day even, right? So the price of this crypto asset can drop by up to 30%. So it's very volatile. And on top of that, right, as we'll see later, that they are often bundled together into an opaque asset pool. So that means the quality of this collateral pool becomes even more uncertain. And finally, an important feature, right, of DeFi is the reliance on smart contract, right, to replace human judgment. Hence, all terms, right, rate, and haircut determination will be pre-programmed. Okay, so as a result of that, typically they generate certain features of those DeFi lending. First is that DeFi lending typically involves a linear, non-recourse debt contract, and the only risk control is basically over collateralization, and that means the haircut, right, of the post imposed on the loan on the collateral will become a critical parameter that controlled for risk control. Secondly, right, as I mentioned, the contract terms tend to be quite rigid because they have to be pre-programmed, right? And also they cannot be contingent on, off-chain information. All the terms have to be contingent on a small set of on-chain quantifiable information, right? Soft information cannot be fit into the contract. And updating this contract is sometimes slow, right? Because it involves a decentralized governance process. And on top of that, there's also trading is often subject to information imperfection. As I described earlier, right, loans are typically collateralized on a pool of crypto assets. In particular, while the borrower, right, can choose to pledge any acceptable collateral on the list, lenders cannot control or even observe the underlying asset collateral pool. I'll give you an example of Aave. This is to illustrate an example. So this is, let's say, the pool, Aave lending pool for USDT Tether. So lender, if you want to deposit, right, basically you deposit your Tether to this lending pool, and in return you will get basically an IOU, right, what they call a token that represent your deposit. And for the borrower, if you want to borrow Tether, you need to pledge collateral subject to haircut, but you can choose to pledge one of over 20 different collateral assets, right? And some are more stable, like DAI or USDC, but some can be quite volatile, like SNX or Chiu, right? The issue is that from the lender point of view, there's no way that they can observe or the composition of the lending pool that's backing this lending pool. That basically is generating a standard kind of adverse selection problem, right? And as I mentioned in the last talk, right, so it is indeed, even for researchers, almost impossible for us to figure out the composition of the collateral pool that's supporting a set of loans. Indeed, almost the only time that we can see that what collateral is backing what loan is when the liquidation event happens. Okay, so this is kind of the information asymmetry between the borrower and lender. So basically, lenders cannot perform any monitoring over the collateral pool, and they have to rely on the smart contract. But smart contracts are passive too, right? So the contract itself, right, can be subject to informational problem. For example, as I said, they does not have access to off-chain information, and they often need to rely on oracles, right, which are sometimes not reliable or not updated frequently enough. One problem that happens is that when the collateral prices provided, kind of the price feed that provided by the oracle are inflated, then borrowers can take advantage and borrow by pledging this inflated asset. And if they default later, that will lead to bad loans. And that happened. There's a few episodes, right, that happened of large bad loans on different DeFi lending platforms. So basically here, so what we try to do in this talk is to present a model that capture these three features, right? That contract based on over collateralization. So the contract terms is rigid in a certain sense, and then there's potentially some informational imperfection. Okay, and I'm going to do it in two steps. First, I will present a simple model, a static model, just to give you the intuition to how we generate this dynamic price liquidity feedback. And then I will present the full dynamic model. In particular, I want to highlight three results. One is how DeFi lending can generate this multiplying effect that magnify fundamental shocks to crypto prices. And secondly, I want to show how a multiple equilibria can arise in this setting and driven by sentiment. And finally, I also want to talk about how having flexible and frequent update of contract terms could help to restore uniqueness. Okay, so this is the plan for my talk. So if there are no questions, then I will go to the basic simple model first. And as you will see, the model is very stylized intentionally because we don't want to capture all the details of different DeFi lending platforms. Instead, we want to incorporate the main components that are essential for our mechanism. So in this world, there are borrowers and lenders, right? Borrowers, they own a risky crypto asset, right, with some random payoffs, while the lenders, they're competitive and they have funding to loan out, right? So typically in this platform, many loans are basically people pledging a risky crypto asset as a collateral to borrow stable coins. That happened quite often in at least in Aave and Compound platform. So this gains from trade, right? It's because the borrower, the marginal valuation of the borrower regarding the funding is higher, right, than the lender's marginal valuation. So we use that to denote the marginal valuation of the borrower. Now, the fundamental friction in our environment that gives rise to DeFi lending is the lack of commitment. Basically, agents cannot commit to future actions, right? First of all, borrowers, because they cannot commit, they cannot borrow an unsecured loan because they would not repay in future. And then at the same time, they may not want to borrow a secured loan from a lender because the lender may not want to return the collateral, right? Because the lender cannot commit to. They can potentially rely on a middleman, right, to provide custodial service, right, of the collateral. But again, this guy, right, this middleman is also subject to a lack of commitment, right, so that they can say abscond, right, with the collateral. So because of that, right, so all this lack of commitment is really the frictions that's behind the role of DeFi lending, in particular in this, decentralized, anonymous environment. So this is how the smart contract works, right? So basically, borrowers can borrow a loan collateralizing on the crypto asset. The collateral will be locked into the smart contract, and it is not released until the loan is repaid, right? If the loan is not repaid, then the collateral will be passed to the lender, right? So of course, there's, as we mentioned, there's a lot of details, right? Who's the keeper, that what they call keeper or liquidator, that's going to take the collateral and repay the loan on behalf of the borrower. But we can add those details. But the basic basically gains from trade and the incentive problem is captured here. So we abstract from all those details, including like the governance holder, governance token holder, for example. And the key thing that what makes a smart contract works is that the contract terms are pre-specified, right? These are deterministic programs, so that there's no incentive problem involved. Okay. So let me tell you a little bit kind of formal details of the model. So the crypto asset we model in a very stylized way. Let's think of it as an asset, right? Durable asset. In each period, it has a random payoff. We can think of this payoff as, right, as could be monetary, right? Such as you get returns from staking, or could be non-monetary, use value of a token. It's drawn from a distribution, f of s. And then you can also resell the collateral, right? You resell the asset at a price, phi, which is determined at the end of the period. So interpretation here is that we have borrowers, they are holding different crypto assets with IID payoffs. Having the IID assumption is just for simplification. So we could extend it to have persistent shocks. The way we modeled smart contract, right? So in this static simple setting, we can think of the smart contract which as specifying two terms. One is Q and D. Q is how much you can borrow, and D is how much you can repay, right? So basically, if you have 1 unit of collateral, you can borrow up to Q units, right? But then you have to repay the face value of the debt, which is D. So the D is also the kind of the debt limit, the maximum amount that you can promise to repay. So at the end of the period, right, the borrower decide whether or not to repay, right? He can either repay or to default and then lose the collateral. So from the lender's point of view, right, the payoff is the value of the debt contract is really given by this minimum of the two, right? So if there's repayment, then you get the D. If there's no repayment, you get the value of the collateral. Okay, and then the key thing is the information friction, right? So sometimes the borrower may observe some private signal. Q, right, can be high or low. With probably lambda, it's a low signal. With probably 1 mass lambda, it's a high signal. So when it's low signal, that the payoff will be drawn from a distribution FL, which will be dominated by the distribution, which is having a high signal. Okay. So the timeline within this single period is the following. First, you observe the contract terms, and then yes.
Hi, could you please repeat what you said, like in the previous slide?
Yeah, which
about the asymmetric information, and also like just to confirm, what exactly is f of s?
Right. So S is the current period payoff, right? Say think of if it's an asset is a dividend, right? So but this is random. No one knows exact realization. So it's drawn from a distribution. Mm-hmm. But the borrower may have some better information, right? About that payoff. So if he receives a low signal, he still don't know the exact realization, but he knows that that value will drawn from a distribution that with on average, will be stochastically dominated by the distribution when the signal is high.
What exactly is a signal?
This is just capturing that this private information. It can be anything.
Okay, that makes sense. Thank you.
Right. So given the terms, the borrower observe the signal, and then they decide whether or not to borrow and how much to borrow. At the end of the period, right? So the payoff realized, and then they decide whether or not to repay or to default. And the asset price will also be asset will be priced at that point. So here, let me tell you the key mechanism here is the information problem that generate adverse selection. So basically, a borrower, after they observe the signal L or D, L or H, high or low, they can choose how much to borrow, right? So basically, they know that if they borrow, they can, each unit of asset allow them to borrow up to Q unit of loan, and that generate a marginal valuation of Z. But they have to repay D. And the key thing is that there is a default option, right? So you can always choose to default if the face value of the debt is higher than the value of the collateral, the realized value of the collateral, right? It's captured by this diagram, right? So this is the density, let's say, of the F of F, right? So of different valuation of the collateral, and D, the vertical line, denote the face value of the debt. So if the value of the collateral is lower than the face value, of course, you choose to default. So the value of the default option is given by the red region, right? And interestingly, right, as you would expect, probably that the low type, knowing that the payoff will likely be lower, right? They would have high incentive to borrow because this default option is higher for the low type than the high type, right? So since the type with poorer expected value of the collateral will choose to borrow, will have high incentive to borrow, that generate kind of adverse selection problem. Also, it means that if both types, right, borrow, but they are borrowed, subject to the same terms, then the high type is essentially cross-subsidizing, right, the low type. Right, if they cross-subsidize too much, the high type will say, okay, I don't want to pool with you, right, because the terms are too unfavorable. So this is a typical kind of adverse selection problem will arise. And what is interesting here is the effect of the asset price fee, right, at the end of the period, asset price, how that affect the incentive. This is, as you can see, as the price goes up, it will tend to reduce the default option because you will have, more to lose if you default a loan, right? That's, in particular, when the asset price goes up, the distribution will move to the right. That means the default option goes down. So since now the high types do not need to cross-subsidize so much, they may want to pool with the low type. Right, so this is how crypto asset price can help to mitigate the adverse selection problem by inducing the high type to pool with the low type. Okay, and when the high type is willing to pool with the low type, right, then of course that will be more favorable for the lenders. Since the lender, they don't know exactly who they are lending to, they just make a rational expectation. If they know that there's a pooling outcome, the high and low will pool together, they will be willing to lend more, right? While if, which is the Q, the amount of loan will be higher. While if they know that it's a separating outcome, only the low type is borrowing, then they will lend less, right? So this is basically the kind of the first leg, right? This right-hand side of this relationship between the asset price and the lending activities, right? So when you have higher price, it helps to mitigate adverse selection, and that helps to induce more lending. And now I talk about the left-hand side of the loop, which is how lending affects the asset price. Basically, how is asset price determined, right? Think about this dynamic durable asset, right? So in a dynamic setting, this asset price will depend, of course, on its fundamental value, but also depends on the collateral value, right? Basically, if you know that tomorrow this asset can be used to borrow more loans as a collateral, then this asset will have a higher value, right? What we call liquidity value component of the asset pricing. So that means when the more lending activity is expected tomorrow, liquidity value will be higher, and that will induce higher asset price. So that complete this self-enforcing loop. Okay, so this is basically how the price liquidity feedback loop works in a simple model. And let me show you the dynamic setting and more formally the result. Okay, so in a dynamic setting, we capture, it's basically repeating this static model with two changes. One is that, well, maybe the borrower does not always have private information or informational advantage. Maybe they have this informational advantage only with probability chi. So basically we use this chi, parameter chi, to capture the degree of information friction in this world. And the second change is that the contract can be updated over time, right? The Q&D can be updated following a haircut rule, which is the haircut rule typically used in a lending platform such as Aave, where specify that, well, you can only borrow loans of only a fraction, right, of the value of your collateral, right? With the haircut parameter H, which is predetermined. Okay, so this is the fixed H. The haircut parameter will capturing kind of the rigidity of the contract. Okay. Now let me formally illustrate how the feedback loop works, right? So basically, in this world, the quantity and quality of loans is determined by the degree of information insensitivity of the debt contract, right? Which is measured by this variable theta, which is the ratio, right, between the value of a debt contract for bad type relative to that for the high type, right? So this is theta would be a number between 0 and 1, right? If theta is 1, that means the value of the debt contract is not sensitive to information state. When theta is 0, it is very sensitive. So as you imagine, right, when the theta is very small, so that means it's very sensitive to information, then the high type would not want to cross-subsidize the low type because the cross-subsidization is too large, right? So that we will have a separating outcome. Only the low type will borrow, the high type will not borrow, and the loan size for each collateral will be low. While if this theta parameter, this theta value is higher than a certain threshold, then we have a pooling equilibrium, right? When we have a pooling outcome, then both of them will borrow and the lender is willing to lend more. Okay, so as you can see, this is a critical value that determines whether the outcome is separating and pooling, and this in turn is affected by two things. One is the asset price, right? The future, the expected kind of asset price of the collateral, right? When the price is high, right? So as you can see here, so the debt contract will become less informationally sensitive, so that it's easier to support a pooling outcome. Another variables, right, that will affect the sensitivity of the debt contract is D, right, which is the debt limit, which ultimately is pinned down by the haircut parameter. So basically, if you impose a very high haircut, right, so the debt limit will be very low, and then the value of the debt contract will not be very sensitive, right, to information, right? And that is going to also can support a pooling outcome. The problem of having a very deep haircut, of course, is that when you set a high haircut, you will also reduce the loan size, right? As a result, that will also distort efficiency. Okay, so this is basically to show you how price is going to affect the quantity of loans. And then, of course, price itself is also will depend on the whether or not it's a pooling or separating outcome, right? So in the pooling outcome, everyone borrows. That means all the collateral will be used optimally to generate this return Z, right? So that will support a high asset price. While in a separating outcome, it's different, right? So some of the informed high type will choose not to borrow. As a result, right, in a separating outcome, the asset price will be lower. Okay, but in both cases, right, having more lending, a higher Q is going to support a higher asset price. So this is formally to show you that how that feedback loop works, right? So how fee having higher asset price will mitigate adverse selection and support more lending, and more lending will increase the collateral value of the asset, and that in turn support a higher price. Okay, so let me use the remaining time to present 3 key results of the paper. Okay, the first one is about sensitivity to shocks, right? How DeFi lending will make the asset prices more sensitive to shocks, right? So, so here is we list 3 collateral prices. First one is that suppose there were low DeFi lending. So of course, asset price is just equal to its fundamental value, right? Pinned down by its dividend, for example. But when there are lending, now depending on its pooling or separating the asset prices, we can write asset prices as multiples of the fundamental value. And we can show that, right, this coefficient, psi p and psi s, they are both of them are bigger than 1, and basically telling you that with DeFi lending, it will raise the price of the collateral value, right? But also, right, because this coefficient is bigger than 1, it also means that the collateral prices with DeFi lending will be more sensitive to shocks, right? Because now with DeFi lending, it will magnify the impact of any shocks to the fundamental value of the asset, to the phi 0. And secondly, right, it will also introduce some new, right, lending specific shocks, right? Any changes in Z or which is the return to a loan, right? Or H, which is the haircut, or the private information parameter, anything changes in this parameter will also lead to a fluctuation in the collateral price. And this is true with or without private information. We still have this kind of magnification effect. Now, when there's private information, on top of that, there could also be additional volatility due to multiplicity, right? We can show that under certain condition, we have a pooling and separating equilibrium coexist, right? And when they coexist, they will, in particular, what we need is 2 things. One is that the private information problem needs to be not too low, right? So chi has to be high. And secondly, the contract needs to be informationally sensitive, sufficiently informationally sensitive. So the haircut cannot be too high. Why? Because as I explained earlier, right? So you can always set a haircut very high so that the contract is not too informationally sensitive. As a result, the separating equilibrium can be killed, right? But if there's private information and the haircut is not too high, then we will have multiple equilibria. And note that this is purely, right, it's purely driven by belief, right? Not by anything fundamental. So if agents believe that tomorrow the lending is going to be very active, then the asset will have a high price today. When the asset has a high price, it will help to support more lending today. So it's kind of self-fulfilling. And this is what we call strategic complementarity. But this is kind of special type of strategic complementarity because it is dynamic in nature, right? Because my lending decision depends on future agents' lending decision. And given this strategic complementarity, then we can indeed construct sentiment equilibria, right? So, which is kind of fluctuations of asset prices and lending activities together, right? According to sunspots. Basically, we introduce some non-fundamental, what we call sentiment sunspots that coordinate people's belief. So when the sunspot changes, people's belief about future lending will switch. As a result, prices and lending will also fluctuate. So how can we, prevent this, fluctuation, non-fundamental fluctuations? Well, one way, as I mentioned, right, from this proposition is that one way to do it is to set a very high haircut, right? By setting a very high haircut, you can kill the separating equilibrium, but it comes with a cost, right? Which is when you have a very high haircut, you will reduce the surplus from lending. Right. So what is the optimal thing to do? So this is the result. The last result I want to show is that we, instead of using ad hoc haircut rule that I introduced earlier, we solve for the optimal contract terms, right? State-dependent contract term. Basically, this contract term will maximize the surplus, and it can also indeed will eliminate multiplicity. The idea is that what you want to do is that when the sentiment is bad, right, that the price is low, sentiment is bad, what you want to do is to set a higher haircut, right? So that limit is lower, so that will help to induce pooling and avoid separating equilibrium. But when the sentiment is high, as the price is high, you can now relax the haircut, right, to allow to maximize the trade surplus. So basically, this is the idea of the optimal that limit, right? But this is turned out to be a nonlinear function, right? It is not captured by that simple haircut rule. And this rule in particular can depend on some off-chain information, right? So you need to get information, say the update according to changes in these parameters. So this is exactly why that pre-programming it may become challenging in a decentralized setting. Okay, so to conclude, I have 2 more minutes. So basically, in this paper, we try to talk about some fundamental issues in DeFi lending. One is that the collaterals are risky, right, and also have uncertain quality. Second, there's some oracle problem, right, and you cannot get always get real-time information from the real world. And third, the contract terms can be rigid, right? You cannot modify these terms very flexibly or frequently due to the governance issue, right? And then because of these features, it will give rise to instability of DeFi lending for 2 reasons. One is the price-liquidity feedback loop that I talk about, and the informational friction will exacerbate this instability. Now, we show that, right, to restore stability, to kill the multiplicity, what you want to do is to have flexible, state contingent, smart contract terms. But how to do it, right? One is that you need to have very reliable oracle, maybe a complex contract terms. Another possibility is that, well, you may need to reintroduce some human intervention, right? So someone do risk assessment continuously, right? So, but that will, again, reintroduce some trusted third party that may defeat the purpose of having this DeFi arrangement. Okay, so thank you. So that's all.
Hey, thank you, Jonathan, for the talk, and we have now some time for questions. And yeah, maybe in case I would like start with one question, and it's maybe also a bit related to some comments that were in the chat, and Kathy, one was already answering, but maybe in terms of linking your model with motivations that you gave at the beginning, maybe you could comment more of the potential sources of the information asymmetry and why there could be different yields. And one thing that I'm particularly wondering about is that if it comes from the fact that I know myself what assets I use as a collateral. So in your model, it is kind of there are good types and bad types, but perhaps it's a situation that if I have all the possible choices, I will always put as a collateral things that I think have this nature of failing with high probability, but maybe having a high return. So at the extreme, if I could use it, maybe I would want to take a very risky NFT, which probably doesn't have any value, but at some point gives me value, in which case I repay the loan. Otherwise, I go to the default. So when linking your model and the fact that potentially I could endogenously choose what assets I would put as a collateral, how to think about this in the context of your analysis?
Yeah, I think this is a very good suggestion. And indeed, I believe that we can easily write a different version of the model. Right here, we just have continuous agent, right? And then each of them is holding one particular collateral. Instead, we could have a representative agent, right, holding a kind of diversified portfolio, and then they can switch the collateral continuously. Yeah, so I think this is very doable.
Okay. And more questions, maybe? And also, I mean, okay, so maybe related to that question, and for the practical implementations that you showed at the beginning, you said that there can be many different assets that can be used as a collateral, but what are the real world limitations of what crypto assets can be used in these cases as a collateral? Because I would imagine that my example of a valueless NFT would not be something that is allowed. So maybe you can comment more on that. Yeah.
Yes, so it depends on platforms, right? So in Aave, for example, they now, I think, you can deposit up to 30 different or 32 different crypto assets, but only I think about 20 of them can be used as collateral. So this is basically all this in the diagram. But still, right, so some of them are riskier than others. So this is for Aave, but for some other more kind of ambitious platform, they accept more, they accept more wider list of collateral.
Okay, thank you.
Of course, it's also that there are, trend that some of these lending platforms will start to accept kind of real world collateral, like mortgage loans or things like that. So that would be another application of a model, right? Because naturally, in those cases, informational problem will become even more severe.
Okay, thank you. Yeah, thank you for the interesting talk. If there are no more questions, then we can still have a short 10-minute break before the last presentation. So we'll resume at 4:30.
Thank you.
Thank you.